When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
There we go. Welcome everyone to MacroEdge Radio. This is John Galt speaking. Welcome on, welcome all. Just a quick announcement. This will be our last 4 p.m. Friday show with yours truly as the host because I have some changes in my personal and professional obligations, which will unfortunately require me to work a lot more hours. It is one of those strange situations where I have to make a change and we have to accommodate here at MacroEdge, but that will not affect things. We're looking to do bigger and better things in the future. Tentatively, we'll be on at 8 p.m. on Friday nights. That is the plan. Today, we have a huge guest list. Melody is going to join us, our ever famous, ever wonderful real estate guru, housing expert, and we're going to sit there and talk about housing today. We have Vinh Vuong, who's going to talk markets with us. Oh, that's going to be a beaut because these markets are everything and anything but normal. And we have, I'm trying to get her pulled up on my system if I can get my computer to sit there and do its thing. And of course, it's not cooperating with my phone. My phone is fine. It's X being X again, and I apologize for that. It's one of those situations where X has been squirrely all week. And without a doubt, I wouldn't be surprised after yesterday's conflict, things are going to get stranger. There she is, Amanda Louise from WorldNet Daily. We're going to bring her up on the air also. It's going to be an interesting show today. I'm going to hit the markets real quick, make a few comments, and warn everybody that this is not going to be your typical show. It's going to be about an hour and a half this time, a little bit new for this audience. When you have this many guests on at one time, we're going to try and give each of them a fair amount of time to discuss it. But just to let you know, we are looking at some strange economic times. Dow was up 471 to 42,791. S&P up 65 to 6,005. NASDAQ up 244 to 19,542. Everybody took the last half of this week off because volume has been meh, and meh is not good when you have a rally like this. It's usually a sign that it's starting to peter out, and I think that will be coming in the weeks ahead, barring geopolitical or economic news to disturb it. Gold was down $40 to 33.33. Silver went on its bull run and technically a setup for a much larger run, closing the week on volume, up 31 cents today to 36.11. Just a heads up on silver. As you know, if you've been following me for 20 years, I've had a predisposed bias towards it as the other precious metal, and it is an alternative that people need to take up and take a look at. I don't recommend investments to everyone. It is insurance against currency instability. I think we'll see that by the boatload. Just a heads up, it's got in potential technically to break out to really, really, really nice levels. WTI up 126 to 64.63. Brent up $1.14 to 66.14. The rig count today was down severely as the drillers are saying, we're not drilling unless we can get our $70 oil back. Bitcoin up 21.80 to 104.330. The 10-year at 451 for the week, 2-year at 404. Once again, we had Japanese banks and insurers selling T-bills on any given night, including last night. Interestingly, the 10-year 3-month re-inverted this morning before 9 a.m., but finished the day up 16 ticks as of 3:30. It's a positive 16 ticks. Pretty scary. Non-farm payroll beat consensus, quote unquote, just sort of like beating your own earnings estimates, but was revised down 95,000. There are major distortions occurring with the Bureau of Labor Statistics, which is why I don't really look at this real-time, quote-unquote, reporting as crucial. But you have to remember, it's rearward-looking, it's revised. The key is to get a big headline out, and it's been that way for 25 years now. Get the big headline out, get the market reaction you want, and later on revise it down. Consumer credit report came out this afternoon, up 17.9 billion in May. That's alarming. Today we had Trump going after Jay Powell to cut interest rates. I'll withhold comment on that. It's just say that he's got to start looking at the bond market and listening to Scott Bessent more. We have a meeting with Bessent, Lutnick, and Greer with their Chinese counterparts in London on Monday. And in the bizarre news that might sit there and get you to say, wait a minute, perhaps we have a bubble that needs to pop. This one caught my attention because I've never heard of it, nor do I care. The coin Skibidi Toilet Coin surged 80% after it was mentioned in a Federal Reserve meeting. No idea. Then also an X account called Coinbase Assets added to their roadmap today, Fartcoin and Subsquid. Please get me off this merry-go-round. Can't we just get some rational sanity return to our markets? Without further ado, and this fantastic guest and I have gone a long way back, and we've traveled over a lot of the same ground. Melody Wright, how are you doing?
I'm doing well, John. Can you hear me?
You sound fantastic. I'm just hoping my ex actually cooperates with us today. That would be sort of nice.
It would be, wouldn't it?
Yes.
Yeah. So, John, I got to tell you, I'm reaching exhaustion level, right? Of just watching this in real time. You know, when I started in mortgage in 2006, in the fall of 2006, I really was on the tail end of everything. So it had already happened, you know. Although there were still some late stage ridiculousness that went on, you know, between late 06 and 08. It's just wild to actually, I just keep thinking, aren't we past this now? Doesn't everyone realize that, you know, the consumer is dead? And they don't. And it's really wild to see these crazy offers coming through. I'm getting them on my phone and email all over the place, and they are really trying to get in that very last bag holder.
Are we now I've seen some postings on X, and it scared the heck out of me.
Yeah.
And what it scared was, we're starting to see, if I'm reading these offers right,
Yeah.
and also pop-up ads and financial, we're now to the point where we're selling HELOCs built into the closing price of a home. Well, am I reading that right?
Yeah. Yes. And I mean, we're doing everything we did before, you know, essentially these silent seconds through these down payment assistance programs. I mean, it's actually incredible, because what I think no one understands is that we were led to believe through all the credit quality gospel singing that everyone learned their lesson, when in reality, the lesson they learned is that there is no accountability. And so, you know, unfortunately, we've all kind of been, convinced by what we've been seeing in mainstream media. You know, even myself, someone who was working in the industry, I really believed that, you know, this would never happen again. Even after went to non-bank after non-bank after non-bank and saw that they weren't willing to actually, you know, abide by the new legislation. And then we know in 2021, they removed the debt to income threshold. And by the way, the GSEs, Fannie and Freddie, never even had to abide by that rule because they had a patch. And so it's fascinating to me just how many illusions that we're actually under now, based on just people repeating it over and over again. But the facts on the ground are that everyone relied on the automated underwriting systems, and if it said approve, and what's the biggest input into those, it's your credit score, then everybody was like, it's all good. And by the way, those that were a little uncomfortable didn't feel like they could deny that person for credit because they were scared of being kind of accused of discrimination. And so you had lenders that just took these government automated underwriting programs, and I mean, they had to, and now they're going to be trapped, and many of them are going to fail. But the lesson that was learned was that you can get away with this, and there is no accountability. And so it is, I think this is going to be very spectacular when, you know, we actually see this bust.
Well, I think you and I have been starting to look at some of the same territory in real estate with everything else. And are we not seeing a repeat of the credit creativity
Yeah.
in the private credit market
Yes.
with worse risks than 2006, 2007. Just an opinion on my part, but I'm reading, every now and then paper floats around that you can see online, and you start reading it and you're going, my God, this is worse than some of the crap Bear Stearns wrote.
Yeah, it's so much worse. And I just saw a note flash across my screen that Ginnie Mae is removing it. It has a cap on its Ginnie Mae 2 securitizations for what buy downs they'll allow. It's supposed to be capped at 10%. They're removing that. And this is a story. I just got my new server delivered, and I'm going to be downloading all the Ginnie Mae MBS, the Fannie, the Freddie, because I think that the buy down story is a much bigger story than people yet understand. I've been saying this for some time, but I haven't had the time to really do the analysis. But when these 321s start to reset in July, this is going to have a huge impact. And it's all creative financing. And John, what scares me the most is not the creative financing we're seeing. It's what we aren't seeing, because I travel around this country a lot, and in every local market I'm hearing these crazy, like, they call them home equity agreements, or HEIs, or Notable is a company that basically will give you a loan to kind of stage your home to sell it. So private credit has gone out there and is funding all of this stuff. And yes, are there legitimate actors like Redwood? I know those guys. Actually, they are, some of them worked with me previously. They're doing things the right way. They're using Fannie Mae underwriting guidelines, which, as I just mentioned, that's a problem. And they're recording the liens, but there are so many actors out there that are not recording the liens, which is making it. And I'm going to mention something I know I've mentioned on here before, but it is just so critical for everybody to understand that the workout for the forbearances of Fannie and Freddie loan were called the payment deferrals. And that's where you could take 18 months of forborne payments and put them on the back of the lien to be paid off when either you sell the home or you just pay it off. And think about that, guys. Let's just say $2,000 is your the standard payment. That's $36,000 that's been withdrawn from your equity, which were not recorded. And so they are not being picked up by CoreLogic, who does the primary mortgage equity withdrawal schedule that everybody looks at as the Bible, as well as you have the private note space. And so when Fannie and Freddie have non-performing loans, as well as FHA, VA, they sell them off into the private market to hedge funds. Those hedge funds then may turn around and sell some of those off to individuals. Those are largely not on these big platforms within the industry, smaller platforms. And I have learned since going to a private note conference in Nashville that they're not reporting to credit. And so we are just completely blind as to how much that equity picture is not what folks really think that it is. And so that is going to be very problematic. Something that Mr. Awesome brought to my attention a few months ago was just looking at the Fannie Mae DTI. When I looked at it in the Black Knight reporting platform, it didn't look as bad, but when you actually look at Fannie Mae and you look back in history, we're now right where we were in 2007. So it is, the consumer is getting crushed out there.
Well, I guess where I'm going to go back to this is we're looking at everything paralleling. Unfortunately, we all were there for that event. I remember the subdivisions being closed off by berms, the homes being bought out for, if there were 2 homes sold, the developer or the courts bought them out and evicted them and told them, get out. We're just going to condemn the entire development. Now we're proceeding to something else, though, that's happening but not catching any attention. We seem to have adopted the same policy of misrating the credit instruments for these mortgages, overvaluing homes, overvaluing what payments are being made, saying, oh, the resident is current, when in fact you and I know they're only current because Fannie, Freddie, and the rest of them, FHA, covered it up.
Right.
So you add the student loan crisis on top of that, delinquencies in credit cards and autos on top of that, and now a large amount of credit applications being declined by loan officers, a normal standard procedure, correct?
Yes.
So you add that into the mix. Once again, we're being misled on the actual rating valuations on these private credit instruments.
100%.
So the problem could be a lot worse
It's
than what they're telling us.
way worse.
And they're going to require the taxpayer to bail out again.
It's way worse. It's way worse. And I mean, I think that I think so. Everyone always wants to point to one thing. This is why they pointed to subprime last time as what caused the GFC. That's not what caused what happened. It was a component, and confidence was lost. And this is an important thing as well. You know, you can look at at the end of 2007, our subprime book was about 12% of our entire portfolio. FHA currently is around anywhere between 13 to 14% of all outstanding mortgages. You know, it just depends on the month. And so we already have as many issues, and that the last report they're very behind, was around a 12% delinquency. We are far, we're already in those dangerous territories. And so, and I think as well, the consumer is much weaker than they were back then. You can look at what is reported, and you can argue about balances and this and that on credit cards or autos, but there is just so much that we don't know, because what happens when rates get this high is the lending in the shadows increases. This happened in the 80s, but you have a ton of creative financing out there, a lot of it being fueled by private credit that is marked to magic, and none of us actually know what it is. And I see someone on this call who just gave me some intel about who's in the private note space, about what notes they are starting to see. They're seeing increases in the tapes, and we call tapes in mortgage. That's just when someone sends you a list of all the different mortgages, et cetera. Increase in the volume, but also increases in the discounts, and that's happening very quickly. So I think we're in an environment that is changing very, very, very quickly, but no one can really, it's hard to see if you're not looking under the hood. And so if you're looking just at mainstream media, you have no idea. Although, as MSM has pivoted on housing, everyone from Newsweek, every outlet now has some sort of story out there about home price reductions, which, you know, this entire bubble has been fueled by narrative. Therefore, everyone out there needs to be very concerned right now, because the narrative has broken, and especially the shortage narrative. I think yesterday we came over 1 million homes listed. Redfin's out there talking about how many more sellers there are than buyers. And so watch the narrative, and the narrative is telling you home prices are coming down.
Well, I'm going to jump right in that, because the Wall Street Journal decided to jump into my backyard this week.
Oh,
and
yeah.
I'm pretty sure you saw,
Yeah.
I'm pretty sure you saw my rant about
Yeah.
that. Because, folks, if you don't know, the Wall Street Journal discovered that people are selling condos in Florida because they have to. Now,
Wow.
I want you to bring this goes full circle. Yeah, wow, shocking development. Why don't you come down here and talk to the people?
Wow. Okay, yeah. Sorry.
Yeah. And of course, the Florida House and Senate decided to play politics with the governor and not reform the condo inspection bill to provide a cushion.
Yeah.
It's the most incompetent thing we've ever seen. And I don't even want to go there. It's all Republicans this time. No excuse with supermajorities. Everybody in the state is disgusted with the Republican Party, and that's going to have consequences next presidential election if they don't get their act together immediately. But that's another subject for another time. The bigger issue is this. If you're an 80-year-old single widow or widower, and you're sitting in your condominium in, let's say, Clearwater or Venice, Florida, prime example, there's a lot of those, and that building has major issues and a major assessment comes down. Am I not correct when I say those owners who have paid off that condo can liquidate at 30 to 40% off and walk away from it?
Yeah. And you know, the other thing that I think everybody should be aware of is condos are not tracked in Case-Shiller. So, you know, this is that's really important, right? We don't see the degradation that's happening out there. We really don't, even though Case-Shiller came out seasonally adjusted with a home price decline. But John, this condo issue is massive, and it's not just Florida, right? It's South Carolina. It's all over the country. And I think that, and this is what's so funny to me, and, why are we even talking about condos, John? We learned in the last cycle not to buy condos. So why are we talking about them again? You know what I mean?
Well, here's the problem I got with this. If the price levels come down 30, 40% because a large number of seniors sell it, bail out, move back to podunk, whatever, up north, or to cheaper housing somewhere else in Florida, does that not drag the entire property valuation for that area down even further, thus lowering property taxes, thus lowering the value of the paper written against those condominiums, and putting at risk the entire building? And folks, you have to visualize this. It's a collective. It's not one unit. It's 40, it's 60, it's 100 units. You put that into default and you crash the prices, you start hitting the municipalities, you start hitting the insurers. It's a cascading effect. And there's a lot of paper behind that that's old paper, if I'm not mistaken, that could easily go in default very quickly if this cycle starts to pick up speed.
Yeah, and I need to look at that, like exactly what is outstanding from a mortgage perspective, because, John, when I lived down, I spent 2 months down in Miami in 23. Most of these condos, we call them the ghost condos, and so many of them have been used for money laundering and things like that. It's really hard to understand exactly, because I feel like there's a bifurcation in those, somewhere like Pembroke Pines, where that is your kind of boomer, middle class, fixed income, versus somewhere like Aventura, where it is definitely foreign ownership and suspicious foreign ownership. And so, I hear what you're saying on that theory, and I kind of agree, but it's also kind of a complicated by so much foreign investment as well. Like, how's that going to work?
That's the question I have, because you have very little recourse except to go after their LLC that's founded in Florida or Texas or South Carolina or wherever. Yeah. And you really don't have recourse to go overseas to collect from these owners.
Right. So let me get to your point about municipalities. And this is something, this is a very slow moving train. And if you're paying attention, I mean, years ago, you could see that this was going to happen. But essentially, we're looking at this Florida market, this condo situation, and really it's something that's happening all over the country, where the municipalities have been using this property tax income. They've gotten used to it. At the same time, they got the big, huge injection from the second bill. It was like $321 billion that went out to I think it was the American Rescue Act, that went out to the municipalities. And they felt rich, and they went and they spent. And then at the same time, home prices were appreciating. And so they were able to charge more in property taxes. And now suddenly they're going to have to deal with a situation, John, where we have vacant inventory that they have to deal with. What happens when inventory becomes vacant? You have increases in blight. One of the things that bailed out the municipalities last time was they created this vacant property registration fee, and all the servicers and banks had to pay it. And so they were able to remain solvent. The problem is a lot of the sales that we had, almost 30% through this last cycle, were all cash sales, which theoretically are not on bank balance sheets, which theoretically mean that there's no one there to actually pay those property taxes, to pay those vacant property registration fees. And so I don't think that the municipalities are going to have the access to the capital they did in the GFC, because they could milk the banks. And the non-banks don't have the money. They don't have deposits. And we'll see some of them implode in spectacular fashion here over the next 18 months, including one who has decided to purchase Redfin and one of the most problematic servicers out there. But yeah, John, the municipalities are in trouble.
Yeah. Oh, I remember when Sarasota County got downgraded to double B minus. I mean, double B minus is not a great rating for those of you who aren't aware. So when you start seeing those kind of ratings hit the municipalities, you can't sell your bonds, boys and girls. It gets very difficult. Your rates go through the ceiling. And that's the contrast. You could have a 0%, 0.5% Fed funds rate, but to sell your municipal bonds, you're going to be begging for 8% if you're lucky at those kind of ratings, correct?
Yeah. I mean, sounds like you know more than I do.
Well, I wrote a piece many years ago during the GFC called Municide, where the suicide of building your entire municipal income, county, state, local, off of property tax fees and collections and servicing fees is a disaster waiting to happen. It came close last time.
Yeah. Can you share that link, please?
Sure. More than happy to do that for you. It's an oldie.
Hey, but it's a goodie, and it's coming into fashion now, John. So if you could share that.
Showing my age.
Yeah, no.
And
we both are, but.
No, Melody and I have a history of going back to 07 and 08, folks. If you aren't aware, we used to drive around the subdivisions in Florida and everywhere else and take pictures of everything that was happening. And it blew our minds then that people were investing in it still, saying, oh, this is the bottom, it's going to turn around. And for 2 years, from 06 to 08, I heard, the bottom is in, this is the time to invest. I'm going to throw something new at you to check out, because I know this is outside your normal periphery with the housing problems, condos, and everything else. I'm starting to hear rumblings about Farmer Mac. And people, if you don't know who Farmer Mac, financing on farms is becoming an issue. I'm understanding delinquencies on family farms are starting to pick up, which is a real estate related issue, folks. A lot of people I've talked to some of the people in Central Florida, and they're running into issues where they thought they could sell their farms to get out of the farming business to developers, and they can't afford to sit there and maintain their farms. So they're sitting on 500, 1,000 acre, whatever. And it's no longer profitable to farm because commodity prices have been suppressed for so long. I'm beginning to wonder if that's going to be the backdoor issue that a lot of people aren't catching, because everyone pays attention, and please interrupt, tell me when I'm wrong. Texas, Arizona, Nevada, California, Florida, blah, blah, blah. Nobody looks at flyover country. You look at Hawaii, which has that dramatic, beautiful beach line of condos and homes. You look at California and you look at Chicago, but a lot of people ignore flyover country. And I think that's a problem the banks don't want to talk about. And I don't think Farmer Mac and the federal government will ever talk about it. I don't see any indication of a bailout there either.
Yeah, they're not immune flyover country. It's just a matter of time. There was a lot of speculation there this time last year. But to the point about the farmers, actually, John, I remember driving in 23 from Miami over to Lakewood Ranch, and just all the citrus, the orange grove farms with signs for sale. It was so sad to see, actually. But when you read about it, you realize they really haven't been able to make money. And I mean, it's really sad, I think, the state of farming in our country right now, because we need these farms. But yeah, I mean, it could be. And now that you've said that, I have to go look into it more. But yeah, it's really it's sad. But Midwest is not immune. I mean, there's no way. Because what happened is Zelman went out, every quarterly update she did, she was talking about the last place to invest is the Midwest. And so you had speculators going and buying hand over fist in Detroit, which made no sense. And honestly, I look at Detroit, it has more potential than many cities if they can get it together, just because it's a port city. But there was no reason for that speculation. And now we're starting to see the Midwest inventory is starting to increase there. And so they will not be immune.
Well, I see Cleveland has joined the parade of home sales declining rapidly also. Yes. So it is starting to infest the Midwest.
Detroit. Yes.
And Detroit, yeah, which I have a feeling with the auto industry in distress right now, because even though sales are good now, you can't keep raising prices like this on the middle class who can't afford it. And we're already seeing some of the most bizarre financing in my entire life. There's rumors, and this is going to be my last question for you, and then you can take it away. I'm hearing discussions about 40-year mortgages again. Is that not the indication we're close to the busting point as far as the real estate industry is going? Because if we have a 40-year mortgage, usually we want to issue a 40-year government bond to back it up, right?
Yeah, I hope it is a sign, John, because I got to tell you, these 40-year modifications depress me to no end. Like, looking when I'm, reviewing in my client books, and it's like, okay, you get a 40-year mod, which decreases your payment by $68 a month. I just want to, I can't even tell you how that hurts. Like, it's awful just thinking about the debt slavery, right? Like, yes. And I mean, 60, and then what's hysterical on the USDA side is when you do a modification like that, and it could be for like a $38 improvement, your servicer or your original, whoever owns that servicing, is having to redeliver that loan into a marketplace, and they're losing like $50,000 to $60,000 on it. I mean, this is just unsustainable. And so I hope you're right, John, because this is it's just getting crazy watching all of this in real time happen. Whereas before, I feel like I kind of came in at the tail end and cleaned up the mess versus watching it happen. And it's really kind of disconcerting, to be honest.
Well, Melody, I don't want to use too much of your time up, but we do have a loan officer who I've talked to for years on here for the last couple of years, Mike Bergmann. Mike, if you want to jump in, please, if you got a question for Melody or a comment, go right ahead.
Yes. So I just want to kind of provide some on the ground level information as far as this goes here. 40 years, this is definitely not happening. This is happening on the modification basis. And from my understanding, FHA with the partial claims and all that stuff is going to happen through 2026 or so. And then it's going to kind of wrap up, from my understanding. We've heard all the crazy stuff on X, especially with the disclosing of the kind of fraud that's happened with the partial claims, which, if for those who are not sure or not understanding of what this is, we've had buyers who have bought houses, made one payment, filed a forbearance, made 0 payments for another 12 months, made one payment, filed another partial claim, and it keeps on tacking on with additional soft seconds that don't accrue interest and just kind of sit on the back end. And but the modifications, on the other hand, those are going out 40 years. They usually adjust the payment plan, the interest rate, but at no point is anyone going to see anything like that in a purchase environment, where you want to go out there and buy a house, not certainly through conventional FHA VA means.
Mike, a real quick question for you. Is it possible that there's no way private credit would ever advocate or approve such nonsense? Because I used to say that I'd never see 10-year car loans, and now we're seeing 10-year paper on car loans, but the interest rates are so absurd, it's not even funny. There's no way we're going to take that subprime route through private paper, non-government backed, correct?
I'm seeing no indication of that. If you are a borderline subprime person, the only option still is FHA. And actually, my office is #1 office in the Southeast United States for my company, and we are pretty much nonstop FHA. Our buyers have no money. They're typically Hispanic from Miami moving to Southwest Florida. These are the worst loans I've seen in my career, and we're seeing them on a regular basis. We're getting them approved because FHA just is really, really, really easy. And as long as they have a little bit of money, we have down payment assistance here in Florida, so it's very simple to do. People are buying a house, renting out an old house. There's absolutely going to be a problem in the future on it. I'm seeing buyers buy in 2023 and then buying in 2024 and then buying in 2025 and giving me a letter of explanation stating that, oh, well, this house has another bathroom and I need it for my other, for another family that's living with me. It's getting pretty absurd.
Well, Mike, Melody, if you got a question for him, please let me know, because I want to ask Mike one more question here, because this is right in Melody's and I's wheelhouse. We're seeing this from a online evidence and driving through their basis. Is Lakewood Ranch one of the premier areas in Southwest Florida starting to see the serious deterioration that the for sale signs and online presence is indicating?
So being in Southwest Florida, I can't consider Lakewood Ranch Southwest Florida. Southwest Florida for me is really from Punta Gorda south.
Okay.
So but this area is probably, if it's not Austin, it's where ground zero for the worst in the nation. Where we saw the first uplift, and we are definitely in about the 3-year recession right now since 2022. But I think Melody had mentioned that the buyer exhaustion, and I have never seen so much exhaustion. And I worked through the 2010s, and where few people were buying, very few people had money. The only reason why my office is cranking out so many deals right now is an exodus out of Miami. And for my loan officers that speak Spanish, they are the top of the nation in my company. For the loan officers that don't speak Spanish, they are asking for advances and cutting down everything they could possibly cut down, because the other buyers are just not there. And anyone that we go in contact with, from the people who are making 150, $200,000, they don't even want to buy a $400,000 house, because they don't want to see the $4,000, $3,500 payment if they don't have a down payment. So it's the exhaustion is really hit its peak limit, and I'm definitely share that with her. And as far as the actual properties, we've hit such a significant number of inventory, where it was skyrocketing. I think we had about 17,000 properties for sale in the Southwest Florida area, Fort Myers, Cape Coral area. In the fall, we skyrocketed all the way up to 24, 25,000 during the season. And anyone selling a home right now definitely has to temper their expectations to a 10th degree. The amount of drops in price that have gone on, I keep on seeing houses that are thrown at me to analyze, and I'm seeing listings starting in January, February, 7, 8, 9 price drops. If they're aggressive, it's just there's no way for someone with an existing home to really compete with the Lennar,
Right.
DR Horton, and all the new construction out there.
Right.
The other reason why our office is successful is because we partner with all the builders who are paying $18,000, $19,000, usually 6% of whatever the purchase contract is. We have forward commitments we do with other builders to do the larger amounts down. But existing homes just going to continue to rise as far as the inventory levels, because they can't compete with a better product at a very attractive price in comparison.
Mike, if I could ask you a question, what percentage of the new are you kind of originating FHA for new homes?
So I would say it's probably about 80, 90% or so.
What?
It's pretty significant.
Whoa. Okay.
And most of them most of them are over 50, 55% DTI too on the back end. And we have a hard line at 47% on the front end, which is the housing ratio. 57% is the back end. But down payment assistance, the other hand, they hard line at 50%. So we do have multiple products that have down payment assistance available up to 5% of the purchase contract. That we're utilizing quite a bit, which isn't so bad compared if you don't have to be a first time home buyer. But yeah, all these are maxed out. There's none of them that are.
Yeah,
I would dream if I could see something that had a 35% back end ratio.
Yeah, so I think that's the first time I saw a back end at 57, I almost lost my mind. And I just called around to everyone going, what's happening? So I think what you're saying is really,
I think
really important.
50% of our pipeline has over 50.
Yeah, I mean, it's so important. So no one should be confused about this is subprime and it's government-backed subprime. But here's the thing.
Well, I just want to consider the one thing here is so I look at my paycheck, and I only actually make about 65% of my gross pay. And if I take that 65% of gross pay after all the insurances and taxes are taken out, and then I would be qualified at up to 57% of that. So I would have only 10% or less of my income to qualify for food, car insurance, and streaming services, internet, all the above based on this calculation.
And God forbid, Mike, you wanted to save money. I mean,
Yeah.
I
What's
mean,
that?
what could that be like? Yeah. So this is where everyone needs to understand is that I mean, we've gone and done it again, and it's actually worse. And then on the servicing side with FHA, this is what happens: you don't get paid. I've never seen a full claim payout. I managed a claims department before. You're often dealing with aging claims, sometimes 2 to 3 years old, where you're looking for documentation you need to submit. They always deny your claim out of the box. And why is this important? Because your non-banks, again, don't have deposits. They need that liquidity to continue to operate. And so when you're waiting for the government to pay you back and they're dragging their feet or they're denying your claims, then you get into a real liquidity bind very quickly. And so I find it humorous. Chase, was part of the Big Five consortium that my company was a part of. They realized we went in all into FHA, which is what took us down, why we went into bankruptcy, because no one really understands the life of loan cost. They only look at cost to originate, cost to service, but in reality, you're always losing money on an FHA loan. But you think everybody gets into it because you get more points on the upfront, as well as kind of in that monthly guarantee fee. And so people think this is an attractive product, but then when things start to happen and expenses increase in default, well, in this past year, what happened? They were getting incentive fees for doing those partial claims, and so they could do 6 of them and continue to get. And this isn't a ton of money, guys. It's like $500 a pop, but it is money coming in. And so it's the only thing that's kind of kept them going as origination has come down. But now we have entered the default cycle, and these non-banks are going to be in deep distress in October 1st when they have to look at the fact that if you want an FHA loss mitigation workout, you cannot be delinquent on student loans. When we get to that point, we are going to start to see foreclosures increase. It takes time. 120 days to refer a loan to foreclosure, but by Q1 of 2026, we are definitely going to be seeing significant increases in foreclosure.
I think that's why that they
And
are
Melody,
dishing them off as fast as possible.
Yeah.
Non-banks are
yeah,
purchasing
and
or completing
Melody,
these and then sending them off to other uh, through the servicing rights.
Yep. Sorry.
Melody and Mike, I
hey
got
everyone,
Vinh
Vin
Vuong joining
here.
us here.
Oh,
Mike, thank you for your patience.
Thank you.
Melody, thank you. But Vinh Vuong's going to jump in and has a question for you too.
Now, I just have something quick to add to what Melody said. One thing to keep an eye on, and this has been very insightful. One of the things to keep an eye on too is the privatization of Fannie Mae and Freddie Mac. Right. So it's coming from DC and Wall Street on my end, there's a lot of talk, both in DC and Wall Street, on privatizing these groups. And you talk about predatory, there's going to be something to
yeah.
keep an eye on, because the reason why they want to deregulate the housing market more and to privatize is to allow more ability to finance and to have less oversight so that they can provide more mortgages and more flexibility. So when you say about the 40-year mortgage, I guarantee that's going to happen if that's the case. So one thing to keep an
Yeah.
eye on going forward the next year or two is you're going to see that happening. And it's going to remind us a
Yeah.
lot of
And Vin,
'08.
I would have to say that I am suspect about the noise around exiting the conservatorship. And I kind of feel like I'll know when they're serious. And right now, it seems to be a ploy to kind of get, in my opinion, it's a ploy to kind of distract folks. But in reality, what's happening is they're actually doing things to kind of make these relationships even stronger. For instance, and maybe ultimately the goal would be privatization, but just knowing what I know about this market, that would take a very long time to affect. And what they're saying right now, I can tell the moves they're making, they're not serious about it. And what they're doing right now is kind of using this as a way to say, listen, for instance, I think they're going after FICO. They want to have Fannie and Freddie create their own credit reporting bureaus, their own products. Some of you may have seen what's recently happened with FICO stocks. That is the largest credit provider, that is the de facto provider. And so I think that this has been more about kind of the Ackman, let me boost the stock, kind of a bone to certain elements of, Trump's base, but in reality, I don't see them being serious right now. But to your point, if they do get serious, then, I would also agree with you that a product like a 40-year mod might be something they would consider.
Yeah. I mean, I mean, look, I deal with DC on a daily basis from all the way up to Trump,
Right.
from all the way up to the president and down, and I can tell you they're very serious about it.
Really?
They're already proposing legislation soon, to make this happen and to lay forth the next steps. Scott Bessent and the Treasury Department's involved. So no, I totally agree with what you're saying. I mean, based on the actions, it may not be serious,
Yeah.
but there is a lot of work behind the scenes
Yeah.
that they're trying to figure out how to make this happen. So it's just something for everyone
Yeah.
to really keep an eye on, and you never know with this administration
Right.
and with Congress the way it is, right? And
And
if it does happen, it's going to be within the next year and a half before the midterm elections.
which would be wild.
So I would say
Yeah.
Q1 next year.
Yeah.
Yeah.
So Vin,
Right after they, yeah.
let me ask you, Vin, and so you have you're talking to these folks. How different is it than this? Is something they talked about quite a bit in the first term. Is it more serious than what they were doing back then in the early days, or same level? What is your gut here, or what are you seeing?
Oh, it's a lot more
Really?
serious. They really want to get this done.
Okay.
Yeah, they actually really, yeah, because um, for multiple reasons. One is to let loose, right, the industry, which I think is idiotic based on the conversations we've had today.
Yeah.
And if anything, it needs a little bit more tightening up. Um, and two, the actions they're putting in place or looking to do will actually accomplish what needs to be done. And it may not need congressional approval for a little bit of time.
Yeah.
So they're trying to find all the legal and loopholes. And the key thing is too, they have some key folks and folks in Wall Street that are supporting this.
That is definitely true, Ben. There's some key folks at
Yep.
Wall Street that want this to happen.
Sadly, I'm on Wall Street, but I'm not one of those people.
Yeah. No. Thank you for that. Again, I mean, if they are being serious, I have not yet seen serious steps, and so I will definitely be looking to you in the future just to see what you're hearing, because this would be a massive change as we understand, and it could be very, very, very disruptive, and probably not work out how they think it's going to work out. So.
I don't think so, too. And trust me, I have very much have voiced my opinion very loudly on how much I'm against that.
Oh, really?
So,
okay, cool.
We'll see how we'll see how this goes. But there's a lot of political reasons why they're doing it, and also economic pressure, especially with this administration, because their policies are not going the way it's supposed to.
Yeah.
Which again, I also warned them about how it's not going to go well. So it's, if anything, they're going to wait until Powell's term ends and before the midterm election before they make any of those kind of moves.
Wow.
Because they need interest rates to get cut before they can do that.
Yeah. All I can say.
Well, Melody. Yeah, that's what I can say too. Because Vin, you've scared the hell out of me. Melody, please promote your Substack and your work for MacroEdge RES, because we do have a massive. Folks, go to macroedge.net/ozone, macroedge.net/ozone. We've got guests to get to. We're going to take all the time in the world it needs. because Vin has added a lot to this conversation from the DC Wall Street perspective. So we're going to just set Vin on fire about markets, trade, and everything else in just a minute. Mike, I want to thank you for your time and input into the show today. That was absolutely great insight, and I think you're right. And I didn't realize you didn't go as far north as Punta Gorda. Collier County is something I'm starting to hear rumblings too. So good luck down there, sir. Oh, I guess he stepped away. Melody, fill us in on everything with. Oh, Mike, you there?
Yeah, thank you.
Okay.
My understanding from Collier County is that it's very quiet, slow.
Oh, Jesus. There goes the big money to save us. Mike, thank you for your time and input to the show today. I appreciate
My
that.
pleasure.
Melody, please tell everybody about your Substack, where they can find you on X, and then we will set Vin off to the races because I have the feeling since his last appearance here, he has a few things to say.
That's awesome. All right. Yeah, you can find me on X Twitter, of course, at M3_Melody, M3 Melody Substack, and M3 Melody YouTube. And thank you as always. And you can find, I also write for MacroEdge and their RE Sites product. So thank you for having me, John.
Thank you, Melody. And I got a speaker who wants to speak real quick. Nikolai, please, if you got a question, pop on in, sir.
Thank you. And just want to express my admiration for Melody's competence in her work. I've been watching it for the last 18 months. And as a result of that, nothing that's going on in the market right now is remotely surprising. And I wanted to ask Melanie about something that she had reported on, and that was the Fannie Mae audit of new home builder surveyor reporting on the actual sales price with the full concession data. And the issue here, as Melanie knows, is maybe they'll report that the nominal price was $425,000 for a new home, but they'll leave out the $50,000 buy down in the mortgage rate and the $20,000 of maybe marble upgrades in the bathrooms and the kitchen. So the economic transaction is $60,000 lower, $75,000 lower. And if I'm and I'm not, but if I'm a lawyer or a prosecutor, if I'm a prosecutor, I'm going to sue for fraud, for misrepresenting the actual transaction price. And if I'm a lawyer and I'm a class action lawyer, I'm going to sue. And I'm going to create a class against the home builders because they're aggressively defrauding the buying public by over-reporting the actual sales price. And I wanted you to comment on that, Melanie. And that's my question. And I'll step down now and listen to the answer.
Thank you so
Thanks,
much.
Nikolai.
Yeah, so on the new home side, we've known this, right, that they are absolutely kind of misrepresenting that top line price because of all of the concessions, and they oftentimes, someone like Lennar will even tell you the average concession per home, which could be a lot of money, $60,000, even more than that. But on the existing home side as well, what's happened, and this is the Fannie Mae study they did, is and this came out at the beginning of last year, is they did a review of 7 million comparables. And they found that 58% of the cases, they did not properly list seller concessions, therefore inflating the value of the home. And so it's bad enough out there, that we had all these all cash buyers and speculation and things like that. But in reality as well, those prices were never real. And so I think you have an entire country almost an entire country that's under the illusion that their home is worth way more than it really is. And often I say, you don't know the true value of your home until you sell it or you get refinancing. And what I think, one of the reasons why I think we're seeing such a high mortgage refi rejection rate, that 41.8% that the Fed reported for February, is likely because appraisals did not come in this time where they wanted them to come in. But all of these values, your Zestimate is not accurate, and your home is likely, the value is way overstated.
Melody, thank you so much for answering his question. You have a great weekend, and thank you for all your time to the 4 o'clock slot. We'll see you again at the 8 o'clock slot, I hope, one time. And someday, when you get back down here to one of the ground zeros, maybe we can go to lunch in Lakewood Ranch with you and your husband and go take a drive around this disaster area. Thank you so much for your time.
Thank you, John. Thanks so much.
Take care. All right, bring up Vinh Vuong, who is one of the greatest. He's going to give us a quick rundown. I'm going to turn the show over to him for a minute because he's got some of the best perspective on Wall Street, as he talked about with Melody. But then if you're saying that you have a property that's worth $100,000 and you write paper against it for $100,000 when it's really worth $75,000, where I come from, that's fraud. But you tell me, sir, maybe I missed something in the DC circle that makes this okay to do now.
Thank you, John. Thanks for having me again. So the issue you have right now is DC and a lot of folks, whether it's citizens or corporations who are outspending what they can actually bring in, are trying to maneuver in every single possible way. Everyday people that are trying to make things work, or organizations or whatnot that are trying to make their their books balance. Is just the reality is hitting them hard right now. So they're trying to find every excuse and push the due date down further and further, and that's what you're seeing, John. So I think that's probably the best way of putting it. Is DC and the government is now hitting a wall because with Trump's policies, which are really irritating our allies and people that are debt holders and sorts, and the check is coming due, no one is willing to buy the debt now. So for all these years and decades that the US was able to carry this debt, and people that were able to buy the debt and trust that America can pay it back, they're not buying it, and they're not going to have trust that America buys it back. So, John, that's the biggest reason why. And they're trying every single possible way with desperation to try to make the due date again push down the road. So when the 100,000, 75,000 discrepancy happens, they're just trying to write it away.
So right now, the extended pretend game is on full bore.
Absolutely, absolutely is. And this is something that my colleague Will and I wrote in the Everything Bubble piece that we published. And it's everything is coming due, and we just don't know how to pay it back. And I think this current administration had no clue how to address it, and does not have the know-how or the means or the confidence to actually take care of this issue, and they're actually making it even worse. So that is something that I think in the next 2 years, that you're going to see the everything bubble pop. So I think we're going to see an '08 like type of economy. In the next couple of years, you're going to see a stagflation type of economy, um, and it's just really sad to see because there are so many ways that our leaders in our country could have addressed it with better policies and a little bit more restrictions, than just passing along and trying to win re-election every 2 or 4 years.
So right now, we're seeing more buybacks. But if I'm not mistaken, and you
Yep.
tell me instead of retiring debt, they're retiring
Yep.
stock. That's usually a sign that we're heading into a very, we'll just call it what it is, criticality. There's a lot of companies that are
Mhm.
borderline, and I'm going to throw one name out there that everybody knows, all the sovereign funds hold, Apple. They're buying back
Yeah.
hundreds of millions, billions of dollars worth of stock instead of reinvesting it in one, domestic production in the United States, and two, expansion overseas production. They're just saying, we're going to build our phones in India and abandon China. But what
Yep.
happens when we pick a fight with India in the trade conflict?
Yeah. So overall, John, I think, I mean, I'm going for hours about this, but I got 10 minutes left. But the issue with America is it happens after World War II. And then it happened again after the dot-com area, and now it's happening in the COVID area. So these three key time periods saw America's industrial production shift to a consumer-driven economy, right? And during those time periods, we never addressed the key aspect of our economy, which is production, right? Whether it's service, whether it's manufacturing, whether it's blue collar jobs, eh, things that actually create GDP growth, and actually producing goods that can sell and actually create jobs, right? And actually provide a living for folks, and to actually increase productivity for the country has been thrown out the door. We are major consumers, but we don't produce anything, right? And that's become the problem. And I think all the conversations we had today about mortgages and real estate and affordability, it all starts with the basic fundamentals of an economy, right? We have people that are spending, 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 but inflation's going up and that's not being addressed. So everything costs more, and it's only getting more and more expensive. And then we're not producing anything. And then we're also not realistic with how the world works today. So Trump comes in, right? The dumbass comes in, and excuse my language, comes in and cuts the world off from us, right? We live in a reality in where we need to have allies and partners in the world because we ourselves don't have the capability and the infrastructure to do a lot of what he is proposing that we do. So we immediately alienate our allies, and then we get cut off from the world. And what are we going to be able to do? So that puts corporations in a terrible position, like you just said, Apple, to be able to do business. You can't just overnight tell Apple, say, you need to build in America. Well, does America have the infrastructure and the ability to actually make the phones, the technology, the batteries? Do we have the manpower? Do we have the education, right? So I'm big on education. Education is a big problem in the United States. We teach, all sorts of things, but one of the key things we don't do is teach actually fundamentals of today's world, right? You go to other countries like in China and India, South Korea and sorts. A lot of the standard teachings is not even just coding and all that, but they actually know how to actually create things. So there's actually in China, for example, in middle schools, they actually have classes and programs that teach kids how to actually put together phones and batteries and manufacturing things. And by the way, in a clean way, they're not, working away like child labor, actually. So that's the problem with the current administration and their policies, and we as a country are not addressing the core fundamental issues of how to bring back productivity, and real GDP growth, and to build actual wealth for our citizens. And we're just trying to throw spaghetti at the wall to try to figure out how to actually address these economic issues. So to backtrack here and just to summarize, the number one thing we got to do is the Fed and the administration has got to get their act together when it comes to fiscal policy, right? We have to look at the reality of that. We have $100 trillion overall uh, credit bubble, because consumer debt's all time high. You talked about mortgage, you talked about student loans that are defaulting. It's starting to increase more and more. You have government spending that's ridiculous. Trump talks about his big beautiful bill when it actually does lipstick on a pig. It's going to add $3 to $4 trillion more, which is going to be a huge issue. And we have to be more realistic with interest rates. Powell, I talked about this before. They prolonged actual hard decisions, and the wait and see policies of the Fed is really putting us in a terrible bind right now, and where they can't make a move because you go one way or the other, it's going to go bad either way. So you have that issue, right? And then you just have the fundamental issue of policy within government on actually how to address, how to create jobs in the areas that we need, to be able to build an infrastructure that can actually make us produce things again. But is that also realistic? I mean, United States population has been stalling.
Agreed. Oh no, I think we lost Vin. I think we lost X. Oh, for Pete's sakes. Can you guys hear me? Oh, no
Things to
way.
going right. It takes a long time to get going again. I mean, it's literally called the belt. It's the what is it? It's a curve. It's the Werner curve or whatever. Um, and it's a manufacturing curve that's proven that the uplift, the cost and time to uplift, to get going, to get to a state of actually efficient, effective manufacturing for a country takes a long time. And you have to get up to that curve and pass that curve before we become efficient. China, these other places have busted that curve and they're doing well. United States, we are back down at the bottom. So what the hell are we doing? So we have to be more realistic with what we're going to do and want to do, and then apply that into policy that's 10 to 15 years, right? So we have to understand what the capabilities that we're able to do, and then create policy around it. So, but
Then
my biggest
and
thing right now is if I was president of the United States, right, I would address two things. I would rip the Band-Aid off with fiscal policy. I would say, look, we're spending like drunken animals. We're not going to lift the debt ceiling. I need cuts. It's going to hurt, but how can we also keep the American people at bay from a standpoint of living? And then we got to raise interest rates, right? We talked about this in the late 70s, early 80s with Volcker. You got to spike interest rates. It sucks, but you have to drive the economy to a real recession before we can get out of it, right? If you do that, inflation goes down, costs go down, and then people can then start to actually afford things and start to borrow again, and things get corrected, right? The economy, it's basic economics 101. It goes ups and downs over time. So you have to go up and down, be able to go. We're trying to go up, up, up all this time, when in reality, we need to go down before we go back up, right? So that needs to be addressed, and we're not doing that. Number two, I would actually have a review of actually where our current workforce is and what can we actually invest and do to be more realistic on how we want to build our economy going forward. And then to then actually partner with our allies then, our actual allies, to then be able to be more productive in a global economy. Because again, it is a global economy. It's not just the US. And the Trump administration has to wake the hell up and understand that. Because China is starting to do things that's really going to hurt us, and you're already starting to see it. Whether it's the rare earth minerals market or other markets, they are starting to really play the game, and it's strangleholding us. You can ask the auto manufacturers who are struggling to get lithium, for example.
well, then I'm gonna go ahead here because this is something that's right into my wheelhouse. We're seeing people not understanding the complications in the supply chain starting to come home. Rare earth magnets are something we can mine for certain elements. There's only one mine in Oklahoma
Yeah,
City, but we can't process it. Same with a lot
right,
of the rare minerals.
exactly.
People don't understand, and you've been in the business. I've been investing in the business off and on. You
Yep,
can start a mine, but it's 5 years to production, 5 years to viable
right,
production.
exactly.
So,
So real quick, John, because I have to get going here in a couple of minutes.
no
Just real
problem. Go
quick
ahead,
on
sir.
that. The issue with the real issue with that too is exactly what you said. And we also don't understand how to play the game. Right? We had the Trump administration sign an executive order to address those issues. We had the Biden administration continue it. But then the problem is the execution is not done. Right? And we're very timid in how we address things. One of the things we could have done, and China does this, is they back a lot of the private equity funds to then invest in those key mines, but then they get tax breaks and write-offs to do that. That was a key loophole around all these things, but everyone just stayed stagnant on it. And then now, and then Trump again, being a dumbass, in my opinion, everyone can criticize me all you want. They were getting into a trade war with China and not realizing and forgetting the fact that we have issues like critical rare minerals, and they're starting to really start to tighten up the supply chain right now. And a lot of Western projects are really getting hurt. I mean, they're sitting on piles, and China's just flooding the market, crushing the the pricing, and it's collapsing Western mineral projects right now.
Then I'm going to ask a real quick question before you go. This is a quick market question because it's something that disturbs me. I call it the glass shelf. You have a rising market trying to rally back. I think it's a bear market rally still. That's my personal opinion. Don't invest on me because I bought some stupid stuff in my past. But let's take reality. When you have a rising market but declining volume, is that not an indicator of exhaustion and speculative froth that's coming to a close
Yes.
pretty soon?
Yes, it's a huge problem because institutional investors are starting to claw back. They have a lot of concern on where the economy is actually going. And if anything, if you look at the volume, it's actually coming more from retail investors, right? That's a big shift that you're seeing lately in the last couple of years when it comes to the markets. Is you're seeing more retail investors. I'm not saying retail investors are bad, but when you see more retail investors with more volume, that's a bad indicator because that means people are not actual heavy hitters and institutional investors who actually understand the market a little bit more, are timid and they're holding back. So that is a big red flag. And then John, back to the stock buybacks and all that, you're starting to see companies with their balance sheets starting to get real worried. And the reason why I do a lot of buybacks too is they're trying to build some more cash piles as well.
Then tell everybody where they can find you, because you are a serious money manager with serious investments. You know
Really
how to
quick.
sit there and tell people how to make it happen. Oh, go ahead, Amanda. Go ahead.
Let me ask a real quick question, because I noticed that you were pushing the India narrative pretty hard. I mean, shouldn't you disclose first that you worked with a company in Dubai the last 2 years, and that you're on a board for that? Because to me, as somebody who's actually an expert into the India exploitation, and trust me, they don't have the manufacturing capabilities. They need people to invest in it currently. They need Apple to invest in it. So the same starting point that they would need to build that mechanism in the US is what we're wanting to push into India. I don't think so. But I think that when you're pushing that narrative, you should probably, expand on the fact that you actually have business and, investments in India.
Go ahead, Vin. I don't follow
Yes.
your portfolio, so please go ahead.
Yeah, I mean, we have diversified holdings. So, I mean, yeah, we have diversified holdings. But if you look at Dubai, I mean, look, Dubai is more an investing hotspot, right? I mean, they're putting money into multiple projects and funds to get a return. I mean, when you look at the Middle East, that's all they're really looking for, to be quite frank. It's just they're trying to put money to work, and there is too much money sitting there. So there is no conflict there from our standpoint. But India, if you're talking about India, India is looking to really attract.
Crap. He is breaking up, and he does have a meeting to go to. Vin, if you're there, go ahead, sir.
Yeah. Yeah, no, sorry. I really have
You're
to
back.
get going. I really do
No,
have to
go
get
ahead,
going. I
man.
apologize.
We'll catch you next time. All right, sir?
I will respond to that. I apologize. I literally have people staring at me and telling me to get the hell out of here. So I apologize.
No problem, sir. We'll catch you next time. Thanks, Vin, and
All
you
right, bye.
take care.
Yep.
We'll talk to you
All
again.
right, bye.
Bye-bye. Okay.
I'm sorry that I cut
Amanda,
you off
welcome
there.
aboard. Well, that's okay. We're just coming on. Please, Amanda, tell us where you're coming from, and we've talked about the subject of the Indian thing. My personal opinion on H-1Bs, because I had a friend commit suicide over this, is that it is an issue that needs to be addressed. However, India is where China was 20 years ago as far as manufacturing, and I think it is something that has to be taken seriously. Please offer your input on that and a little bit about your background for our listeners who are new to you.
Yeah, so I'm from the Midwest. Not originally an immigration expert. I kind of had to fall into that after experiencing not only companies offshoring, but having to work at a big tech company that where Americans were the minority. And I challenged to ask why that was, and was retaliated against. And after discovering documents that talked about getting rid of U.S. citizens so that they could keep hiring more H-1B, I decided to learn everything that I could about immigration and immigration law. I profiled big tech companies and even caught them red-handed in an operation I called Operation Red-Handed, where I challenged them to actually consider Americans. And when they didn't, I started working with the Department of Justice. I have about 100 investigations that are going on with the Department of Justice that are investigating big tech and medium tech companies that do have discriminatory hiring practices. This led me into the India aspect.
You still there? You dropped off on my end. I don't hear you.
Sorry, can you hear me now?
Now you're back. Go ahead, Amanda.
I don't know where it cut off, so I apologize.
That's okay. You were talking about your background. So with this going on, do you view this as a deliberate government policy, or is this something that, because I'll be honest, We've changed administrations. We knew the Biden administration was for sale. That was obvious to everybody in the known universe. But you also have people like Mike Lee and Ted Cruz who sold out their voters and conservative supporters to support enhanced H-1B importation. But yet there seems to be no accountability for the other party when they do it. And I'm really just sick and tired of hearing this saying, oh, well, we're in charge now, we're going to take care of it. And instead we expand it.
Yeah, so part of my work with the Department of Justice, I used the employer's own paperwork to confirm that mass majority, if not almost all, H-1B applications and permanent residency applications have some form of fraud or misrepresentation. There's deficiencies in our laws that protect Americans. And so we're incentivizing the abuse of these programs so that they can get more compliant and cheap labor. When I started noticing the mass layoffs in 2023, when I would do my profiling, so I profile the immigration practices of employers and offshoring practices, I started to notice a trend where, like, for example, Salesforce, when they were doing their layoffs, they had already gone into these contracts with the India government to expand not just operations, but to also create their future workforce by investing in India and having contracts with the India education institutes that are controlled by the India government. They would create Salesforce's next million workers tailored to whatever it was that Salesforce was looking for. If you wanted AI, if you wanted machine learning, if you wanted product managers, they would tailor those individuals' certifications to that. So they wouldn't have a real degree, but they would have a Salesforce certified skill set. And what I notice with my work with the Red Line Project and my work as the investigative journalist for WorldNet Daily is that when they would do layoffs, they would also be mass hiring in India and investing in India as well. So that kind of led me into getting into more of the India government and reports and agencies that they have that, not only work in India, but also work and thrive in the US, pushing, policies that favor India. The India government is very much integrated into our policies. In fact, they don't feel that it should be a political concern. They think it should be a business concern. And that completely defeats the purpose of our Immigration Nationality Act, our laws around immigration, which is supposed to be that immigration is supposed to only enhance the workforce, not to replace the workforce. So by making it a business scenario, you're just enforcing the idea that it should be used for cheaper labor so you can be, quote unquote, more competitive. What you notice is that the India multinational enterprises that are in the US are the ones that created the dependency of IT and back-end infrastructure processes like your development and call centers in India. They're the ones that started that. Now, being a contracting service where most of their contracts came from American companies and governments, they were able to be more competitive than American companies, pushing them out because they were able to offshore half the work. And so they were able to offer bids at much lower prices. Now,
okay, well, that's all nice, but here's the big question. I was asking a question about, since neither political party seems to want to address this seriously, and there is an increase in H-1B visas structured into the big, beautiful bill where it gives more free will to companies, what the hell are we supposed to do as voters? That's the question I have. If the Republicans suck and the Democrats suck and Trump sucks, where are we supposed to go? We're running out of options, yet we seem to still have this open gateway for H-1Bs to accommodate the corporations, but we don't want to sit there and hold the politicians responsible.
No,
that's my big issue.
I completely agree. And that's my standpoint of it too. Like, I can be mad that India's having manipulative processes and trying to control our policies. But at the end of the day, it's up to our representatives to stop that. When are we going to put America first? Because India is certainly putting India first. Every time that we've expanded these programs, it has expanded offshoring, and not just offshoring, but foreign direct investments, our research. All of that is now being heavily invested into India. Our American multinational enterprises contributed about $2 trillion into India last year.
Hello?
Sorry, it's every time my phone goes black. And then the Indian multinational enterprises from America also contributed another 1.5 trillion into India because they are also offshoring. So we're reinvesting as we're expanding these H-1B programs. And I will tell you, I can't even count the millions of Americans that are out of jobs, or graduates aren't getting jobs. And now India had launched on May 6th this initiative to have what they call circular migration, where they're hoping to fill the Western civilizations with 250 million Indian internationals in the next 25 years, with the first group of 50 million to come out by 2030. We don't have enough jobs for that, but they're using this narrative that there's a skill gap that's so large, and all these other countries need India so desperately that they want to come here and help us. But while they're going to do it, they also plan to take 300 billion in remittances. And so that one big, beautiful bill that you just mentioned, they're also saying that we're discriminatory because we baked in 5% tax on that. And that kind of ruins their plan of their $300 billion remittances. And that does fuel the India economy. That whole narrative that, oh, it's just people sending money back home, that goes into the India National Bank, which gives them the capital to then fund loans and money. And they've talked about this heavily in their own government documents about how important it is for their diaspora, so their Indian nationals that are in the US, to continue to sending these remittances, which is why the goal of increasing not just H-1B, they now want to be an H-2, and they want a new visa that's supposed to be.
Well, they're going to get it. That's for sure. I can see that coming. Jesse has a question. Jesse, are you there? Jesse. Well, I was hoping Jesse was there. All right, guys, we're having so many technical difficulties. We're going to have to sit there. We're having so much intermittent transmission here. I apologize to all of our listeners. This is one of those situations where we're trying to have an interview with someone, and X once again is having stupid technical difficulties. Guys, we're going to wrap this up. I should be back next Friday at 8 p.m. Amanda, I apologize for the problems we had with this. I don't know what the hell's going on. X has been squirrely as all give out lately. I want to thank everybody who's joined us for the last year or so at 4 p.m. on Fridays. We're going to go back to our evening times. We all have personal and professional obligations. We're going to have to reset that. MacroEdge.net/ozone, MacroEdge.net/ozone. Don't miss that 2-week free trial. If you can hear me still, everyone, tune in next week. Look for an update for the 8 o'clock show. For MacroEdge Radio, this is John Galt speaking. Good night now.